Hello everyone, and welcome back to Dr. Tao's Quant Lab. In the last lecture, we saw how the Federal Reserve sets the absolute baseline for short-term borrowing. But the Fed doesn't directly control the broader financial market. The broader market is governed by a completely different mechanism, the US Treasury bond market. Today, we are going to look at how government debt acts as the ultimate gravity for the stock market. When the US government needs to fund its operations, it issues treasury bonds because they are backed by the US government. They are universally considered the ultimate risk-free asset. When a bond is issued, it has a fixed coupon payment. For example, $100 bond that pays $5 a year has a 5% coupon. That cash payment never changes, but in the secondary market, the price of that bond fluctuates every second based on the demand. Because the payout is fixed, the actual return you get changes based on the price you pay. Mathematically, the yield to maturity is exactly the same thing as the internal rate of return, or IRR. It is the discount rate that equates all future cash flows to the current price. Look at the summation formula in your textbook. The yield is strictly in the denominator. Therefore, the math is inescapable. Price and yield move in opposite directions. As the yield goes up, the fractions get smaller, and the price drops. For those of you taking actuarial exams or interested in the exact formula for the price of a bond, here's the equation to calculate the price of a bond, and I may consider to calculate this later. Now, not all bonds matter equally to stock trader. Short-term yield like a 2-year just track the Fed. But the 10-year US Treasury yield, ticker US 10Y, is different. It is widely considered the mother of all interest rates. It perfectly balances short-term liquidity noise with long-term inflation risk. It is the exact benchmark used to price global corporate debt and 30-year customer mortgage. It is the true cost of capital in US dollars. Look at the chart here in your textbook from 2025 to 2026. You can see just how violently this global benchmark can swing. So, what happens to the stock market when the 10-year yield rises rapidly? It triggers three massive quantitative effects. First is the capital allocation shift. When yields are near zero, institutions are forced to buy stocks to get any return. But when the 10-year yield hits 4 or 5%, institutions can get guaranteed risk-free return without stock market volatility. Trillions of dollars instantly drawn out of equity and into bonds. Second is the DCF valuation effect. Remember how the yield was denominator in the bond formula? It works the same way for stocks. When you value a company using discounted cash flows, you discount future earnings back to the present using that 10-year yield. If the yield goes up, the present value of future cash goes down. This mathematically crushes growth and tech stocks because their valuations rely heavily on earnings expected 10 years from now. Third is the interest spread effect. Will tech stocks get crushed? Bank stocks actually rally. Banks borrow money from depositors at short-term rates and lend it out for mortgage at long-term rates. When the 10-year yield rises, the bank's profit margin mechanically expands. If you want to be a quantitative trader, you cannot just look at a stock's chart. You must watch the 10-year Treasury yield because it is the macroeconomic gravity that controls everything else. And this officially concludes chapter 1. You now know the pieces on the board and the force that move them. See you in the quant lab.